Welcome to the SWIB Market Update. I'm Chris Preisler, Communication Specialist for the State of Wisconsin Investment Board, or SWIB. Each quarter, we will talk with SWIB staff about the economy, the markets, and how the Wisconsin Retirement System trust funds are impacted. We'll also discuss how SWIB is working to help the WRS remain among the nation's most resilient pension funds, growing and protecting participants' benefits and giving them peace of mind to focus on work, life, and the future. Please make sure to subscribe in your favorite podcast app so you don't miss an episode. Share this podcast with your fellow WRS members and leave a review on Apple Podcasts so it's easier for other members to find this show. Today, we welcome back SWIB head economist and Asset and Risk Allocation Chief Investment Officer, Todd Mattina. Todd, thanks for joining us.
Thanks for having me.
So Todd, the last time we talked to you at the end of 2025, we were finishing a strong year with double-digit equity gains and solid bond performance. At the start of this year, things felt upbeat, driven by AI earnings, expected rate cuts, and global economic growth. But by the end of the first quarter, markets got more volatile. Can you talk about those issues that caused the switch we saw through the first 3 months of the year? And as we sit here on April 9th at 10 a.m. talking, can you talk about some of the things that are impacting the markets today?
Sure. Great question. So the first quarter was clearly a volatile one, both in financial markets and geopolitics. We came into 2026 with the so-called Magnificent Seven stocks continuing to lead the market after a very strong 2025, driven largely by enthusiasm around AI. At this point, those companies make up more than a third of the total value of large cap U.S. equities, as represented by an index like the S&P 500. But that enthusiasm started to cool a bit in the first quarter as investors focused more closely on the scale of spending required to build out the AI infrastructure. The so-called hyperscalers, companies like Meta, Microsoft, Amazon, Google, and Oracle, are expected to invest roughly $515 billion in capital expenditures this year alone, rising towards something like $750 billion by 2028 based on analyst estimates. In general, most of these companies are incredibly profitable, but that level of investment will weigh on their free cash flows in the near term. And naturally, investors are starting to ask tough questions about the return on investment from all that spending. At the same time, those investments are providing a meaningful tailwind for the broader U.S. economy, especially as geopolitical headwinds have been rising. The conflict involving Iran has pushed up the volatility and level of global energy prices, which consumers have already felt at the pump. And that's not surprising. Roughly 1/5 of global oil exports pass through the Strait of Hormuz in the Middle East, making it a critical choke point, not just for oil, but also for natural gas and key industrial inputs like petrochemicals and even sulfur, which is essential for fertilizer production.
So you mentioned the conflict in Iran has led to higher oil prices. And of course, we're all feeling that when we stop to fill our cars with gas. Beyond feeling that pressure point at the pump, what does the conflict and the higher oil prices mean for the U.S. and global economy?
Right. Well, the main risk of a protracted Iran conflict would be a stagflationary shift. That is, higher inflation combined with slower growth. Now, that's unlikely to resemble the extreme form of stagflation of the 1970s, but directionally, the shock would be similar, rising energy prices, putting upward pressure on inflation while weighing on economic activity. Now, for the U.S., the impact is more nuanced. We're now a net energy exporter, so higher oil prices actually improve our terms of trade and support parts of the domestic energy sector. But that, of course, doesn't mean it's painless. Consumers are clearly feeling it, with gas prices above $4 a gallon, and the inflation impact is meaningful. In fact, market pricing and forecaster surveys suggest inflation could remain elevated again this year, marking the 6th consecutive year above the Fed's target. One important difference from the 1970s, though, is that the U.S. economy is now far less energy intensive. Today, we use roughly half as much energy per dollar of GDP as we did back then. That helps cushion the macro impact, even if households are still feeling the squeeze. Globally, though, the effects are more severe. Europe, Japan, and much of Asia are heavily dependent on imported energy, so higher prices act like a direct tax on growth, worsening trade balances and pushing inflation higher. And because energy is priced in dollars, a stronger dollar during periods of geopolitical stress makes things even more expensive for those economies in their local currency terms. So, higher energy prices are like a tax on income for these economies. Large manufacturing economies in Asia depend on that energy from the Middle East. So, higher prices are squeezing profit margins and disposable incomes at the same time. In Europe, the shock is also reviving fears of the 2021-2022 gas crisis. Countries like Italy and the United Kingdom are especially exposed because of their reliance on gas-fired power. Ultimately, a lot will depend on how long the conflict persists and whether energy flows through the Strait of Hormuz are disrupted in a lasting way.
So, Todd, I want to focus on interest rates for a minute. The Federal Reserve, in its first meeting of 2026, held rates steady after the market started the year pricing in multiple rate cuts. We seem to be in a higher for longer rate environment. What would it take for the Fed to actually deliver rate cuts? And what is the risk that they stay restrictive longer than the markets expect?
Yeah, so the increase in inflation expectations clearly raise concerns about a possible higher for longer interest rate environment. With the energy shock, both market pricing and economist surveys have moved towards higher expected inflation, and investors have quickly adjusted, pricing out two Fed rate cuts in 2026 that had been expected earlier this year. In fact, the Fed is now dealing with a classic supply shock. Higher energy prices push inflation up, which argues for tighter policy. But at the same time, higher prices weigh on growth in the labor market, which would normally call for easing. So the Fed's dual mandate is in tension, and that makes policy decisions much more complicated. A lot hinges on how persistent this energy shock turns out to be. Right now, futures markets suggest investors are expecting oil prices to come back down over time, even by the end of this year, which would imply a relatively temporary impact. But until there's more clarity on the duration of the conflict, both the Fed and markets are likely to stay cautious. Stepping back, though, the bigger story may be less about the next rate cut and more about the overall level of interest rates. There are structural forces today pushing upward on yields, particularly a surge in government borrowing in the US and the other advanced high-income economies. Treasury issuance this loan could approach somewhere between $1.6 and $1.9 trillion dollars, and potentially more depending on growing fiscal needs. At the same time, debt levels are projected to rise even above their post-World War II peaks, which means global investors are being asked to absorb a growing supply of government bonds in an environment where inflation uncertainty is still elevated. That combination helps explain why long-term interest rates may stay higher for longer.
And one other topic I want to touch on is private credit. Private credit's been in the news a lot lately as this rapidly growing asset class faces rising default rates, increasing investor redemptions from retail clients, and rising regulatory scrutiny. But despite the headlines, it seems like fundraising and institutional demand remains strong. How is SWIB thinking about the private credit space?
Right, this is an important development. Private credit has definitely been in the spotlight lately with concerns about rising defaults, redemptions, and regulatory scrutiny. Some of that pressure is real and reflects a mix of factors, including disruption from AI in sectors like software and business services, which are meaningful exposures in some private credit portfolios. But an important distinction, and one we emphasize at SWIB, is that most of the stress highlighted in the financial press so far is concentrated in retail investment vehicles, not the institutional funds that SWIB invests in. The main systemic risk, though, is that if those retail funds face heavy redemptions from investors, they could be forced into selling their assets quickly, which might put downward pressure on valuations across the broader private credit market. Now, that said, the structure of these funds helps mitigate the risk. Many of them have gated redemptions, which limit how much capital can be withdrawn by investors over a given period. Those gates are specifically designed to prevent fire sales of assets and help stabilize the market during periods of stress. So in that sense, they're doing what they're supposed to do, protecting remaining investors and reducing the risk of a broader liquidity-driven sell-off. And looking ahead, if retail demand for private credit does moderate, that could actually create better opportunities for long-term, disciplined investors like SWIB who can take advantage of more attractive pricing without being forced sellers.
So there's just a lot going on right now, Todd, a lot to keep your eyes on. And given all the issues that we've talked about, what is SWIB doing to keep the WRS trust funds positioned for long-term growth?
So SWIB is a long-term investor. which aligns directly with the long-term nature of our liabilities. We're investing to support benefits that will be paid out over generations. That means our approach to long-term growth is really about finding the right balance. We need to achieve a return that's high enough to keep the plan financially strong, while also managing volatility to avoid downside risks like sharp swings in contribution rates or pressure on the plan's funded status. As part of that process, at our December 2025 board meeting, trustees approved a shift to slightly reduce allocations to policy leverage and public equities. The key point of those changes is that we can now achieve a similar long-term return target, but with lower volatility, which strengthens the plan's stability over time. And we're also being selective. Large-cap U.S. stocks look relatively expensive today, mainly due to the high valuations commanded by the so-called Magnificent Seven stocks. So we're tilting towards areas where we believe valuations are more attractive and long-term return potential is stronger.
Todd, that's a lot of great information you provided. Like I said, there's a lot going on and a lot to keep track of. So I'm sure that WRS participants will be happy to hear that SWIB is on top of things and keeping the trust funds positioned for long-term growth and success. Thanks for taking some time this morning to give us an update on the markets and the economy.
Thank you again, Chris.
And thank you for listening. The SWIB Market Update is brought to you by the State of Wisconsin Investment Board and produced by PodCamp Media, branded podcast production for businesses, podcampmedia.com. Thanks again for listening. I'm Chris Preisler.